Good morning. It's a real pleasure to be here at the Denver Gold Forum. This is the first time that we've presented Millennium. And as the title of the presentation suggests, we're an existing gold producer. We're a single asset company. The Nullagine Gold Project sits in the north region of Western Australia in the Pilbara. Millennium is a really interesting and very exciting growth story, and it's sort of come from very humble beginnings. A little over 2.5 years ago, I was part of an executive team that came in to Millennium, which was a reasonably distressed both company and distressed operation. In a little over 2.5 years, we've turned the company and the operations around significantly and returned a fair return back to our shareholders. But I think the most exciting part of this presentation is what we've set ourselves to do and the foundation we've set to take us from what is an existing 100,000 ounce production asset to something that we could see with a higher production profile and certainly higher margins, and look to start returning some of that free cash flow back to our investors. So we set about early this year and we sort of looked at, how could we bring 80,000 ounce, 75 to 80,000 ounce production asset into something that's going to be far more meaningful and certainly focus on bringing improved margins. This year we're going to produce around 75 to 80,000 ounces, but more importantly we sort of took a really big step back at the start of this year and really committed to a multi-pronged growth strategy, and that was predicated on aiming to bring our production profile up, which we're already now running at 100,000 ounces. But we also started with a very modest mining reserve. So in the end of 2015, we only had 12 months of mine life. And slowly but surely, we've sort of maintained our production rate, we've reinvested back in exploration, and our reserve inventory is now starting to grow significantly. So we've been limited to only adding oxide ore sources to our reserve inventory, and that all changed in the middle of this year. So our reserve base now sits at 3 years, but by the end of this year we'll see it at around 4, and then through the course of 2019 we're aiming to bring that back up to 5 to 7 years. So how have we done that, and how have we resurrected the company from 2015? We've focused on bringing in larger scale, longer life deposits, so essentially bringing in bigger gear, moving more dirt with less machinery and less people, and we've been very successful at that. The real kicker here is how do we bring in higher grade ore to our plant. And one of the biggest challenges that the operation had when we took it over in 2015 is that they had a significant reserve impairment and write-down. It was a typical gold operation going into production. It went through a scoping study, pre-feas, and then a feasibility. It went out and got senior financing. So it had an initial 7-year mine life, and that's what they constructed it on. 5.5 years of that was represented by the largest deposit called the Golden Eagle deposit. And what they found when they were mining that is that when they went through the oxide ore into the transitional fresh, the recoveries dropped right off from 90% to down to 50%. So essentially the ore was encapsulated in sulfides, and the CIL plant that they had couldn't treat those ores economically. So our big focus over the course of the last 2.5 years, while we've only been able to mine oxide ore, is then how do we modify the processing plant to be able to treat those higher grade sulfide ores and bring a lot of those resources back into reserves. And we've been very successful at doing that, and we unveiled our feasibility study on that solution earlier this year, and we committed to it about 3 months ago, and that will be in place by Q1 next year. And we'll go through some of those components later in the presentation. We also, as part of our strategy to bring higher grade ore into the processing plant, we moved from a sole open pit operation asset to focusing on how we're going to bring in our first underground. And again, we committed to that early this year, and we've successfully brought that on stream, and the first high grade ore from our underground started arriving in the plant about a month ago. And it's all underpinned by our absolute commitment to exploration. So in 2016, when we sort of set about resurrecting the mine life of the Nullagine Gold Project, we ended up spending $14 million of exploration to try and resurrect that 1-year mine life that we were faced with. In 2017, we spent $21 million of it in exploration, and this year we're going to spend $16 million. And all of that's being funded out of free cash flow from operations. And we have not been back to the equity markets to support that exploration strategy since 2015. And what we've seen through that commitment to exploration is some significant breakthroughs, and that's where we see a significant uplift in our reserve base coming, but also bringing in higher grade into the processing plant. So if we look at this corporate overview, one of the things that we have to continually address is the shareholder base. So the IMC group sits there at 47%. To sort of cover off how they ended up at 47%, it sort of goes back to the recapitalisation in 2015. And what the company had was a senior debt facility linked to the construction phase of the project, but it had also started to borrow subordinated debt from the IMC group, who at the time was a 30% shareholder. When we recapped the company, we needed to get them to convert that subordinated debt to equity and bring in some new money to kick off exploration again. So we continually get asked about the IMC group, so it's probably a good time to address who they are. They're a private family fund based out of Singapore. They've got over $13 billion under management there, so their main focus is on shipping and logistics. So what we've done as an executive team is we've resurrected a huge amount of value for the IMC group, who were faced with getting zero return on their equity exposure and certainly getting zero return on their subordinated debt facility. So with their support, we've been able to resurrect Millennium. They're a very passive shareholder and a very supportive shareholder. Their exposure to Millennium is only quite small in the grand scheme of their overall, their larger fund. And what we are for them is we're their only exposure to precious metals or gold, and they see us as their vehicle for gold exposure moving forward. If we look at our board and management, we've also worked very hard at bringing, resetting the board, but also the senior executive team as the strategy for Millennium's changed. So 18 months ago, we brought on Tim Kennedy, and last year we brought on Peter Lester. So Peter Lester, ex-Oxiana, Tim Kennedy was the group exploration manager for the Independence Group. And then more recently, through last year, we brought on Dean Will, who joined us from Anglo American Global. Ray Parry, our CFO, came to us in December last year. And Ray has a long history of being a CFO for successful gold companies. So he was at St Barbara. He was CFO for Northern Star for 4.5 years, and before he joined us, he was with the Hang King Group and managed a $300 million sale of an asset in Australia to Minjar. So the important thing for us with that is that if we're looking to build our market capitalisation, again in 2015, it was a $5 million company with $40 million of debt. And so now we've built it up to around 130 million US or 170 Australian. And we're not here to sort of continue that and stand still. What we want to do here is now move towards $1 billion company. And to do that, we're going to invest heavily back into the organic growth opportunity at Nullagine. But more importantly, as our cash flow will start to increase through next year through our increased production profile, is to look for additional assets and grow our global production profile to over, from 100,000 ounces from Nullagine to something that will be more meaningful, where we will get a re-rating from the market. And we've brought in the people that have done it before, and it's been really exciting for us to be able to, in the last 18 months, attract that calibre of resources into the company. So if we look at the Nullagine operations, we've made a significant turnaround in the operations through efficiencies and productivity focus. We've spent a lot of money back in the plant, and we've turned a 1.5 million tonne per annum processing facility into a 2 million tonne per annum processing facility. We've really focused on our mine scheduling and our stockpile protection, especially when you consider in this region there is a lot of wet weather through the December and January and February months. And so we've really focused on stockpiling and making sure that we've got ore up at the ROM when we do encounter those weather events. If you look at the reserve history, it's sort of what I was talking about earlier. In 2015, we started with 125,000 ounces of reserve. That was in January. When I joined the company in mid-2015, those reserves were 90,000 ounces, so it was pretty grim. With the exploration focus, we've incrementally started to add to that reserve base, but we were very limited to only bringing in oxide ore. So it certainly hasn't excited the market. When you sort of see 2016, 180,000 ounces of reserves. But what we're starting to see now that we have a solution in place for treating the higher grade sulfide ores, is that reserve position is going to start to really climb. It's going to start climbing very fast. And it has a direct correlation also, by bringing in additional production to our all-in sustaining costs. We have been a reasonably high all-in sustaining cost company, albeit we have been generating strong margins. But with the increased production profile, we can see our all-in sustaining cost through the course of 2019 drop substantially from 1,300 Australian down to around 1,100 Australian. And if we can start to bring our production profile above 100,000 ounces, say towards 120, we can see our all-in sustaining costs dropping below that $1,000 mark in Australian dollar terms. So if we look at the expansion study and what we've done to bring resolution to treating sulphide ores, through the course of 2017, we committed to a pre-feasibility study on bringing a flotation solution, which is a globally well understood way of treating or recovering gold out of sulphides to create a precious metal concentrate and then market that concentrate through to the Asian markets. So we were quite pleased with getting through to that phase. And what we did in December 2017, late last year, is we brought in an engineering company called Ausenco and a mining consultancy, metallurgical consultancy group called Minescope. And what we asked from them is we asked them to challenge our pre-feasibility outcomes, which it was essentially around a $50 million capital spend and a 12-month build to supplement the CIL process. And with very quick time, they came back to us and said, you know, what we've deployed in other operations around Western Australia without using flotation has been very successful. They've put it in place and they've been involved in installations through some of the Goldfields assets in Western Australia and also at KCGM at the super pit in Kalgoorlie. And so what they've called it is tail scavenging. And the premise of this is that we've got a very coarse grind at the front end of our CIL plant. We're getting around 50% recoveries of gold encapsulated in sulphides through the CIL process, which in its own right is not economic. But what we've got here is a flowsheet design that shows that we will put all material through the front end of the CIL plant, allow the CIL plant to recover 50% of the gold encapsulated in sulphides. We're still getting plus 90% in our oxide ores, but then grab those sulphides from the tailings. So using heavy media separators, the sulphides twice as dense as the rest of the tailings material, so it recovers wonderfully through heavy media separation. Take those sulphides and apply an ultra fine grind down to 10 micron. Hit them with a bit of heat into some small tanks, oxygen cyanide, fast track the oxidation, and then put it back through the front end of the CIL plant. And by doing that, our test work's shown that we can get another 50 to 60% recovery. So all told, the sulphide ores are showing 75 to 80% recovery, unoptimised. And the real win for us on this front was that the capital spend was only $15 million. It's a very simple process, and the additional processing cost is around $3.50 a tonne, as opposed to the flotation option, which was showing us around $10 a tonne. So the significant operating cost saving has been the real winner here. So as I said earlier, we've committed to this. We've ordered the mills, we've ordered the spirals, and this will be starting to arrive before Christmas, and then we'll start commissioning through Q1 next year. And this will be in place by the end of March 2019. The other focus that we've had, again, is moving away from these modest grade oxide pits and then bringing our first underground operation into play. So through 2017, we started our first deep drilling program, and it's really important to understand in Nullagine, when we say deep drilling, we say below 80 metres. We've got an entire gold belt here that hasn't seen deep drilling below that 80 metre mark and into fresh rock. So we went about drilling underneath 4 of our existing 30 deposits, assuming that once we go into the fresh rock that we were going to see recovery challenges and metallurgical challenges. But what we found from those 4 deposits is that 2 of them presented as free milling through the CIL process, quartz shear hosted gold, and so it allowed us to fast track that underground development without having to wait for a new solution on the processing. And so Barton's was the first one that we attacked, and what we ended up doing here is we did a big cutback on this pit and then commenced a portal in April of this year. We've only drilled it out down to the first 5 levels, and what we've done is we've drilled deep enough below it to know that the ore bodies continue, but rather than drilling it out from surface, we've chosen to drill it out from underground. So the development here is down 3 levels. The first development ore hit the plant about 4 weeks ago. The mineralisation here is definitely open at depth. It's delivering around 20,000 tonne a month to us to supplement our oxide feed. We think that we can upscale this through the course of the first half of next year to around 30,000 tonne, so around 350 to 400,000 tonne of plus 5 gram dirt coming into the plant. The drilling platforms are in here, and we'll commence drilling here middle of next month, and we'll have an intensive 6-week program focusing on drilling out the strike extents and the depth extents. The thing that's really important to note with Nullagine is that we've only drilled underneath 4 of our 30 deposits. Each one of them is open at depth. And so now that we've got the confidence with our first underground underway and with the sulphide treatment optionality taken care of, that we've got a real focus now on bringing in multiple underground operations here. So by Christmas, we'll have a second approved underground, and we'll be looking to develop our second underground through the course of the first half of next year. If we go to our exploration, and again, you know, we sort of have had a lot of success with our exploration strategy. Walking away from Golden Eagle, which again was 5.5 years of the original 7-year mine life, has been a real sort of elephant in the room for us. It's the largest deposit in the belt, but because we knew that the ore types there were refractory and semi-refractory, we could not afford to sort of deploy any exploration effort to them. But once we've sort of resolved the sulphide processing optionality, it gave us the confidence to go back to Golden Eagle. And through the course of the last 18 months, we've spent about $1.5 million on desktop studies on Golden Eagle, trying to understand the real complex structural component of the mineralisation here. It sort of presents as a very different beast to all the other deposits, which are all subvertical. Here we see a lot of multiple deformation events. We recognise there's multiple mineralising events. And so once we sort of got back and we remodelled this and reinterpreted it, we started a big cutback here about 4 months ago in preparation for delivering sulphide ore to the plant. And then we put the exploration guys in here. And what we started to see when we started to deploy things like geophysics and spectral work, we started to see very subtle features in the mag and very subtle features and alteration halos that looked to present as cross-cutting structures or potentially some sort of Rydell shearing. And so the exploration guys had a few theories, and they turned the drill rigs around and started drilling a different orientation to target these cross-cutting structures. And what we've seen here is a massive breakthrough for us with the Golden Eagle deposit. And you can see by the grades, and we've had more grades and more results come out since this presentation. And they're not visible, so it's been a real challenge. We can almost forgive our predecessors for not recognising these because they don't present as visible quartz veining. They're still siltstones and sandstones. But once we've started to understand them, the high-grade component that we're getting here across multiple structures, over 250 metres in strike, is a real game changer. So what we've done here is we've taken the mining fleet away, pushed them onto other deposits, and we've pushed all of our exploration efforts into this area now. We've got 3 drill rigs, 3 RC rigs sitting, drilling out these cross-cutting structures, and we've got a diamond rig arriving next month. So this is going to be a major focus for us between now and Christmas, and we see a significant opportunity for an uplift in our reserve base. And if we look at exploration generally across the entire belt, we control over 280 square kilometres of a Archean greenstone belt in our own right. And if you look at these results, you see multiple high-grade hits and maiden discoveries all in the last 3 months alone. So while we're still focused on Golden Eagle, we also have 1 drill rig out doing reconnaissance work, and we're making multiple discoveries every quarter, and they're all very high grade, and we're now going to start attacking those at depth also. So if we look at the key investment takeaways, you know, we've worked really hard on resurrecting this operation and turning it from a really distressed asset to now generating strong cash flows. And through the course of next year, we will start to see an opportunity for us for the first time to maintain the rage on exploration, but certainly start to significantly rebuild the balance sheet at the same time. Our production and mine life is increasing, and it's going to get some real momentum through the back end of this year and certainly through 2019. The plant expansion will be in Q1, and again, that's a real game changer. The underground opportunity for us also is going to be a massive focus on how we're going to bring higher grade ore into the plant. And if we start displacing that modest oxide ore, we can start to see our production profile significantly lift beyond that 100,000 ounce mark. The exploration program will continue, $16 million this year. We've already earmarked another $15 million for next year. And so that's sort of how, in a little over 2.5 years, we've turned a company around and we've started to return significant value to shareholders. But I think the best is still yet to come. And I've got 10 seconds left, so thank you.
question at the back.
Peter, just a quick question. Great to see that you've got Ausenco involved in the design of your sulfide plant. I was just wondering, to what level they'll be involved in the commissioning of it, and if there's anything in the way of process guarantees that they might have provided.
Yeah, it's been really interesting because, while we're deploying, a flow sheet design that's being used at 4 or 5 other mine sites, and we're benefiting from the refinement that they've been able to do to that process over the last 15, 17 years. We have got some really interesting patented reagent usage technology that we're using to deploy in-mill oxidation. And they've gotten really excited about that. I mean, for a company the size of Ausenco, a $15 million build, is nothing. But they've been really keen to stay on board with the project, and they want to commission it because they want to slap their name all over it. And we're really pleased to have them. We were originally planning on just doing it ourselves, but it is a really quite simple sort of modular installation. So Ausenco will be there right the way through, and they want to sort of get on board with seeing how they can also deploy some of the similar technologies to their other opportunities and builds.
Okay, thank you, Peter.